Federal Reserve Minutes again due just about 2 p.m. Eastern Time. Joining us now is Peter Morici. Peter is an economist and professor at Robert H. Smith School of Business at the University of Maryland. He's also one of Bloomberg's best on the economy. Bloomberg best means, just to remind you, we bring you only the best people on the economy. So we've crunched the numbers to find the most accurate forecasters in the world, and Peter Morici fits the bill. Welcome to you. It's great to have you on the show, Peter. So tell me, do you think there's been a lot of behind the doors struggling, debating about what to do with this extended period keeping rates low language that's been in the accompanying statement with the Fed meetings, the last couple of meetings, right?
Absolutely. There's a big tug of war inside the Fed. There are those that see all the liquidity the Fed has created as dangerous, and there are those who actually read the textbooks and see what the quantity theory of money from which currency inflation comes from. Basically, it's premised on the notion that you're at full employment. So if you print more money, you can't get more goods. But anybody who looks outside can see that we have lots of unemployment, lots of slack in the labor market, and businesses are not passing along higher commodity prices, higher productivity growth, and so forth. So the core rate of inflation is as low as a snake's belly. If you can find inflation outside, then next year I'll be playing starting point guard for the Detroit Pistons.
I'd like to see that, Peter. Let me ask you, though.
I'm 5'6" and 61 years old.
I bet you, well, maybe you could be a coach, but your analytical skills, that's a big play in sports of late, right? Do you want to ask you, though, inflation's certainly not a problem, but what about this notion of disinflation, all the slack in the economy? I mean, does the Fed have a problem there?
The reports that we're getting these last couple of weeks indicate not. For example, rents are starting to rise again in big cities. If any place deserves some disinflation, it's land values in and around big cities. Look at Stuyvesant Town and Peter Stuyvesant Village in Manhattan. It's being sold off for much less than its original owners had paid for it. Simply, the land was bid way out of the ability of people, the tenants, to pay the rent. But even there, we're starting to see rents firming. So my feeling is no, we're not in danger of deflation. We truly have a Goldilocks environment right now for stocks and the economy.
All right, so back to rates in the minutes here. Do you think that someone, or we'll get a little bit more insight, that somebody is joining Thomas Honig of Kansas City in saying let's get rid of that extended period? And if so, what is your personal outlook on rates? If extended period means 6 months till we see a rate hike, what do you think?
My feeling is they don't have to do much about rates until the summer, and they may find, because of unemployment, that they would prefer to wait until October, and October really means after the midterm elections. I don't think they're going to want to raise rates for the first time in October. So I don't think we're going to get a higher rating. We're going to get higher rates until summer or November. I think Honig will have some allies, but the reality is the Fed is going to move on the numbers. And if we get a couple more months of very low core inflation, that will permit Bernanke to do what he wants to do, and that is delay.
Delay until we really see an improvement in unemployment? I mean, the payrolls number finally increased, but again, stubborn unemployment.
No, I think he's going to raise rates before we get a significant improvement in unemployment. Low rates can only do us so much good on the unemployment front. The unemployment situation is not going to resolve until we grow the economy at closer to 4% a year than the 3% most economists are expecting. And for that to happen, we need significantly more demand, which means we'll have to do something about our trade deficit. That requires the president to do something about trade with China, and Geithner has just booted the currency issue into the summer. I find it very amusing that he thinks he can accomplish talking to the Chinese what George Bush and Bill Clinton could not accomplish talking to the Chinese, or Hank Paulson couldn't accomplish. My feeling is we're not going to get significant progress on the yuan. So we're not going to get unemployment coming down, but inflation will start to become more of a concern come fall.
All right, Peter Morici setting us up ahead of the release of the Fed's minutes from the last meeting.